Level 1, the research analyst. You are 23 years old, and you have just made the strangest trade of your life. Not a market trade, a personal one. You left a bank that had your name on a badge, a clear title, a training class of people who all knew exactly what came next. You walked away from all of it for a fund with 11 people, no training program, and a base salary of $120,000. The number sounds significant. It stops sounding significant the moment you do the math on what the people 3 levels above you are making. If you're enjoying this content, a sub goes a long way. All right, back to it. The fund is called something unremarkable. One word or a number or a name that means nothing until it means everything. You are sitting at the 3rd desk from the window in a room that smells like cold coffee and stale ambition. There is no open floor. There is no intern class. There are 11 Bloomberg terminals and a whiteboard covered in numbers you do not fully understand yet. Macro. That is the word they use to describe what this fund does. At the bank, macro was a category in a presentation deck. Here, it means something different. It means the fund does not bet on whether a specific company will do well. It bets on how the world will move. Interest rates, currencies, the debt of entire governments, the direction of an economy before the economy knows where it is going. Your job is to read central bank statements, economic data releases, transcripts of speeches given by finance ministers at conferences in cities you have not visited. You read all of it, and then you write a summary, and the summary goes to the senior analyst, and the senior analyst decides whether it is worth mentioning to the portfolio manager. Most of your summaries do not get mentioned. This does not mean they are wrong. It means the fund has a specific view of the world already built, and your job right now is to feed that view, not to challenge it. You challenge it anyway, in the margins of your notebook, where nobody looks. You keep a personal log, a currency you think is overvalued, a country whose debt looks fragile from where you are sitting. You write it down and you date it and you keep going. At the end of your first year, the portfolio manager makes a trade that costs the fund $40 million. The loss is absorbed quietly. Nobody raises their voice. Nobody holds a meeting. The number simply appears on the attribution screen the next morning, red and specific, without theater and without blame, and then people start working again. You have never seen a loss handled that way before. The professionalism of it unsettles you more than the number does. You are 24. Total compensation this year is $210,000. You have not pitched a single idea that has been acted on. You have been here long enough to understand why that is not yet your job. You are still building the map. The map takes years. Level 2, the analyst. You pitched your first macro thesis at 26, and the portfolio manager listened for 11 minutes without interrupting. That is the detail you remember, not what he said after, the 11 minutes. The thesis was about a currency, the Turkish lira. You had been watching it for 8 months. A government borrowing too much, spending faster than the economy could grow, with a central bank that kept borrowing costs low even as prices climbed. The logic was simple when you stripped it back. When a country spends more than it earns for long enough, its currency eventually pays the price. You had been building the case for how soon and how much. You built the model. You ran the scenarios. You stress tested the numbers against 3 different outcomes, and the trade was profitable in 2 of them. You presented it on 14 slides, and the portfolio manager asked 4 questions. You answered all 4. He told you to model the 3rd scenario more carefully. You did. He told you to do it again. You did that too. 6 weeks after the original pitch, the fund built a small position. The lira fell. Not because of your thesis alone. Currencies move for many reasons at once. But the direction was correct. The fund made money. The portfolio manager said 2 words to you in the hallway. Good work. That is the performance review at this level, and it is enough. Your base is now $150,000. Your bonus last year was $180,000. Total compensation of $330,000. And the number would feel significant if you ever stopped to think about it, which you mostly do not, Because thinking about the money is not the job. Thinking about the next thesis is the job. You are building a reputation inside 11 people's heads. It is the smallest audience in finance and the only one that matters right now. Level 3, the senior analyst. You specialize now. The fund gave you a region, Southeast Asia, or Eastern Europe, or Latin America. Yours is a collection of economies that most funds only watch when something goes wrong, which means you see things before they go wrong, which is where the edge lives. You are 29. You travel twice a quarter, and this is not leisure. You fly to the capital of a country most of your peers cannot place on a map, and you spend 4 days in meetings with local economists, government officials, journalists who cover the finance ministry. You are building a picture that cannot be assembled from a screen in New York or London. You walk the streets. You eat in places that are expensive and places that are not. And you compare the gap between those two things against what the official economic data says is happening. Sometimes they match, sometimes they do not. When they do not, that is where you start. A senior analyst at a macro fund is someone who has stopped waiting to be given an answer and started building the answer before the question is asked. You pitch 3 ideas a quarter. The portfolio manager acts on one of them. That ratio, 1 in 3, is considered exceptional at this level. Most senior analysts land closer to 1 in 5. Your total compensation last year was $680,000. Half of that was bonus, which means half of that did not exist until the fund decided it did. That is the texture of this life at this level. The floor is real, the ceiling is not. And the distance between them changes every year based on whether you are right. You are starting to understand something that nobody told you when you joined. Being right is not enough. Being right at the wrong time is the same as being wrong. If you call a trade 6 months too early, the loss burns through your credibility before the market moves in your direction. The thesis has to be correct and the timing has to be correct. And you need to be able to hold the position through the period when the market tells you that you are wrong before the market tells you that you were right all along. Most people cannot do this. That is why most people are not here. Level 4, the portfolio manager. You run a book now, $350 million allocated to you to manage, not to advise on, not to pitch ideas about, to move with your own decisions every single trading day. Every morning the market opens and that number shifts because of calls you made. You are 33. Your compensation is no longer a salary with a bonus attached. It is a percentage of the money you make for the fund. When you are right, you earn. When you are wrong, you earn less. And if you are wrong enough times in sequence, the conversation about your future here becomes a different kind of conversation. This year, you made a trade on Japanese government bonds, a bet that Japan's central bank would eventually have to raise interest rates after 3 decades of keeping them near zero. The thesis was straightforward to explain and difficult to execute. Japan had been buying its own government debt for years to keep borrowing costs low, a policy that could not continue forever without serious consequence for the currency and the bond market alike. You built the position slowly, over 9 months, sizing it carefully. Because if you were early, you needed to be able to survive being early. You were early by 4 months. The position moved against you by $62 million before the central bank changed course. You held it. You had modeled the early scenario. You knew the floor. The fund's risk committee reviewed the trade twice during those 4 months, and each time you presented your updated thesis, without changing the conclusion, the bank changed course. Rates moved. The position finished the year profitable by $114 million. Your cut was $3.2 million. The number sat in your account, and you looked at it for approximately 40 seconds before opening the next morning's briefing. The market does not celebrate with you. It simply opens again. If you've made it this far, you're exactly who this channel is for. A subscribe helps me keep making these. No pressure, but I'd appreciate it. Level 5, the Chief Investment Officer. You are the strategy now. Not a contributor to it, not a builder of one piece of it. The entire architecture of how the fund sees the world runs through you. You are 39. The fund manages $8.4 billion across positions in 17 currencies, 6 sovereign bond markets, and derivative structures tied to interest rate decisions in 9 countries. Every position in the fund reflects a thesis that either came from you or was approved by you. Every risk the fund carries is a risk you chose to carry, which means every loss is a verdict on your judgment. Your compensation moves with performance. Last year was $4.8 million. The year before was 1.9. You do not build your life around either number because doing so would be a structural mistake. You have watched senior portfolio managers do exactly this. The mortgage size to a good year, the lifestyle calibrated to the bonus. When the bad year arrives, and it always arrives, the personal pressure bleeds into professional decisions, and professional decisions made under personal pressure are the most expensive kind in this business. You manage a team now, 4 portfolio managers, 9 analysts, 3 risk managers. You review every major position twice a week. You kill ideas that are good but do not fit the portfolio because adding a good idea to the wrong portfolio is noise, not insight. Every position changes the risk profile of every other position. The whole thing is a system, and you are responsible for the system's coherence, not just its components. Investors fly to your office twice a year. Pension funds, sovereign wealth funds, university endowments. They manage trillions of dollars in aggregate, and they have given you a portion to deploy. They are professional, patient, and they will pull their capital without a difficult conversation if your numbers slip for long enough. You spend 2 days being precise and accessible and completely composed. Then you go home, open the terminal, check the overnight positions, and start again. Sleep is something you manage with the same deliberateness you apply to sizing a currency position, between 4 and 5 hours, rarely at the same time, 2 nights in a row. Level 6, the founder. You left. That is how it begins for most founders. You were right too often to keep sharing the result with someone else's fund. You are 44. You started 6 years ago with $300 million from 4 investors who believed your track record more than they needed to believe your pitch. The fund is now $2.3 billion. You built that number from nothing, and your name is on the door. And what that means, practically, is that every gain is yours, and every loss is also yours, in a way that an attribution line inside a larger fund never quite was. There is nowhere for the loss to go except your name. You have 11 employees. You know each of their names, their strengths, and the specific conditions under which each of them produces their best work. You know which one will stay through a volatile overnight session without being asked, and which one generates better ideas in the morning than at any other time of day. You deploy them accordingly. You have learned that managing people well is the part of this career that the career never trains you for. The market trains you to manage risk. Nobody trains you to manage the person who generates the idea about the risk. Your investors trust you. That trust is the most valuable and most fragile thing you have ever managed, more fragile than any position, because positions can be unwound. Trust, once it starts moving the wrong direction, moves fast. 1 bad year does not break it. 2 does not. 3 in a row, and the letters start arriving. Professional and respectful, each one saying the same thing in different language. You have seen this happen to other founders, and you know what the 3rd letter does to someone who built their identity entirely around being correct. You have not received 3 letters in a row. You received 2, once, during a period when your thesis was right, and your timing was 14 months early, and you held the position, and it ultimately returned 14% for the year. But the letters came during the months when it looked like it might not work. 2 of those investors did not stay. You do not think about them often. You think about them when you are building a new position, and you ask yourself honestly how long you can hold this if the market tells you that you are wrong before it tells you that you are right. The answer, every time, is longer than it feels. Right now, at a bank in London or New York or Singapore, a 23-year-old analyst is sitting in a room reading a report about a country he has never visited. The country's currency has been losing value for 6 months. The central bank has been raising borrowing costs to slow the slide, and it is not working. He has been watching the pattern for 3 weeks. He has a theory about why the medicine is making the patient worse. He opens a blank document. He starts writing the thesis down, not to send to anyone, just to see if it holds when the words are in front of him instead of inside his head. He is still at the bank. He has not thought seriously about hedge funds yet, not as a real possibility, not as a road that could actually belong to him. He thinks this level of work is where the decisions get made. He has not yet seen the room where the decision happens after the analysis is finished. The document has 4 paragraphs. He reads them back. He adjusts 2 sentences. He saves the file with a date in the title and closes the laptop and goes back to the work he was actually supposed to be doing. The thesis sits in a folder on his desktop. It will stay there for 11 months, until a chance conversation at a dinner he almost did not attend mentions a fund building a position in the same currency. He will remember the document. He will open it the next morning. The thesis will still hold, and it will be better than he remembered, because he has spent 11 months learning things he did not know when he wrote it. That is where it begins. Not with a trade, not with a fund, with a document nobody asked for, dated and saved, and almost forgotten, written by someone who did not yet fully understand what it meant that he could see what he was seeing. The market does not wait for him to understand. It simply continues, as it always has, moving before the reasons are obvious, rewarding the people who were building their map while everyone else was still reading the headline. When he arrives, the map will be what gets him in the door.